It's Tuesday, November 5th. Welcome to Market Foolery. I'm Chris Hill. With me in studio from MFAM Funds, it's Bill Barker. Thanks for being here.
Thanks for having me.
It's hot IPO day. We've got three companies reporting earnings. All three were companies of intense interest when they went public. Doesn't mean all the IPOs were great, but two of them were from this year alone. We're going to start with Uber. Uber's third quarter report, they lost $1 billion. There were other numbers too, but shares of Uber are down more than 8%, and I'm assuming it has something to do with the fact that they lost $1 billion in 90 days.
Probably has a bit to do with that. They are growing rapidly, still 30% top-line growth. They'd like you to look at that number, but the market is looking at the bottom line instead, which ends up not being a fair fight for Uber because it is just going to keep talking about the top line. It is saying, well, we can be adjusted EBITDA positive by 2021, which is a lot of adjustments there.
I was just going to say, there are a lot of caveats that come with that.
Yeah, a couple of years out, if you don't look at EBITDA, which is not looking at net income, but you look at adjusted EBITDA, then, and you squint real hard, you'll see that we look like we're not losing money years from now in this world.
Right.
And then the market is looking at the fact that tomorrow the IPO lockup expires, and so you've got a lot of new shares available for sale. And so I think that maybe some of today's selling has something to do with wanting to get out before more people get out tomorrow.
Yeah, I think I've made this point before. It's a little bit like in your personal life saying, don't judge me by my looks, judge me by adjusted handsomeness. Because on an adjusted handsomeness, I'm pretty close to Brad Pitt. If you adjust. And just straight up looks, no, nowhere near that. But adjusted handsomeness, sure. Yeah.
Adjusted future handsomeness?
Exactly, in 2021.
Look, really, when we're both dead,
exactly.
I'm going to look just as good.
It's interesting, and we're going to come back to this with Peloton. It does seem like we are absolutely at this point with the market right now where there are a lot of investors, and a lot of them are probably institutional investors, who are not willing to put up with things that they were willing to put up with 6 months ago, 12 months ago. And so Uber is saying, look, we're growing the top line. It's like, that's fine, but that's less interesting to us than it was last year.
Yeah, I think that you've always got a large chunk of the market, which is going to be value investors and who always care about earnings. And then you've got the growth investors who are excited about the top line growth, maybe more so than the bottom line. But there are a lot of other companies out there that are growing the top line in a very healthy manner as well. And so Uber's presentation that, hey, we can grow the top line at 30%. Let's not look at the bottom line is up against many companies, largely in the software space, that are growing both the top and bottom line by impressive amounts. So Uber's growth story is in competition with profit growth stories, and that's not a good fight for it to be having.
I'm sure there are some growth investors who look at the drop in Uber today and say, well, it's down 8%. I like this even more because I'm willing to hold it for 5 years. Are you one of those people?
Well, I've seen a couple of analyst reports talk about sort of dropping their target price, but still having a target price around double of what the current share price is. So they're focusing on, hey, the 2021 adjusted EBITDA profit, maybe that doesn't sound great to you, but we were thinking it was going to take even longer, till 2023 maybe. So today's news to us, and we're willing to tilt our head a little bit and squint and look at the numbers in the way that Uber would like us to look at them. Now, maybe that's because these analysts are looking at Uber's need for financing in the mid to near-term future. Maybe they need to raise more cash, some bonds to cover all these these losses. So, they might want to be on Uber's good side. You always have to season your analysis of Wall Street's work with that perspective. But, the growth is impressive. Uber someday could pull back on how many different businesses it's losing money in and probably come up with a quicker profit growth story than is presented so far. And, maybe that's something to hang your hat on.
Still trading below the IPO price. Let's move on to Shake Shack. Yesterday, there was a headline I saw, and the headline was, "Will Shake Shack's spectacular 2019 continue with its third quarter report?" And the answer appears to be a resounding no, because Shake Shack down 20% today. Same-store sales in the third quarter came in at 2%. That's only 0.5% lower than what was expected. But I think, to go back to the headline, it actually has been a very good year for this stock. And Shake Shack has sort of moved into this category as a business. Maybe we're not expecting perfect results for them, but in this environment, if they're going to miss, then we're taking some money off the table.
Yeah, a lot of things to say about this one. One, to focus on that headline as to what was spectacular. Was it Shake Shack's business year or the stock year? And the stock year had been spectacular, and one wonders why to that degree. And if you look at a chart of Shake Shack, it's one of the companies that I like to refer to as the stock having visited lots of different interesting places. And it skyrocketed after its IPO, got up to, I don't know,
90.
90.
It was north of 90.
Came down to 30 after that, back up to, close to 90 again, and now it's at 60 some. And if you look at the actual operations, it's a fairly smooth growth story, which just doesn't have quite the highs and lows that the chart would suggest. And, profits it's trading at 100 times earnings. So its same-store sales are 2%. Yes, it can open a bunch of stores, but why are people paying 100 times earnings for this company? I think they're asking themselves that, based on the 20% drop in the stock today.
And even with the drop that we're seeing today, the stock is still up around 50% year to date. So it is interesting, though, because you're right. This is not a business that has been what I consider to be overly aggressive with their expansion plans. They've been pretty steady with it. So I'm not really sure why they are afforded the multiple they're afforded. I assume at least part of it has to do with a decent concentration of its locations in New York City.
Possibly that, possibly having captured because of that some of the financial media's attention. I mean, the amount of mentions that Shake Shack gets on something like CNBC in proportion to the size of its business is fairly odd. But it's a good growth story. It is actually profitable, as it should be, given its size and the business that it's in. But one of the problems with this report was it referenced that it is moving from using a number of different delivery services to only using Grubhub, and that is going to impact sales to the downside, which makes one wonder just how much is Grubhub offering Shake Shack to be the sole provider of delivery services for Shake Shack. How much is that worth it to Shake Shack to sacrifice some additional sales, because they must be getting a pretty sweet deal from Grubhub. And if you look at Grubhub's stock price, you'll see that it must have gotten into a lot of bad deals because it's going nowhere.
Yeah, I think this is something to keep an eye on just from the standpoint of whether it's 2020 or thereafter. Be on the lookout for one of these two companies being quick to announce, we're no longer part of this deal.
You've got to wonder, what is in it for Shake Shack, because they are highlighting that as something which is certain to create uncertainty about the rest of the year's sales, same-store sales. And
which, by the way, they lowered guidance for that for the full fiscal year as well.
Right. So they're in part because they're just going to be delivering and selling less because they're in a number of markets. I think Grubhub is very dominant in New York, but not so much in many other markets where Shake Shack needs to have its food delivered. And if people can't get it delivered through their preferred vendor, then they may just not be getting anything from Shake Shack. At the margins, I mean, it's bringing same-store sales down, I think, 1.5% or something is the guidance. I mean, there are fairly small increments that this is moving around by, but it is moving, as it always has, the stock much more than the business itself.
Peloton Interactive issued its first report as a public company. Peloton reported a loss, which I can't imagine is surprising to anyone. Their revenue, however, more than doubled year over year, which is similar to Uber. That's the thing they'd like you to focus on.
They would, and it's I think, easier story to buy in terms of just look at how fast we are growing right now and look at how many things we could pull back on to create profit if that was what was most interesting to us and our board. And the CEO stated and tried to sell that profitability is not something that they are focused on as they are exploring and growing in international markets and putting more money into R&D. And if you've got a subscription model like they do, you can have some reasonably reliable future revenues. So it's not taking the same kind of hit that some of these other things are. But to go back to, I think, the overall point, hey, growth is good. What about profitable growth? If you can't deliver that, plenty of investors are willing to look at profitable growth stories. Well,
I find it interesting that Peloton is investing in the ways that you mentioned, and yet John Foley, the CEO, on CNBC this morning said that they were contemplating doing a Super Bowl ad, and they decided not to do it. And I'm paraphrasing, but he said something to the effect of, we didn't think that would go over so well in the current climate. And I thought, you know what? You're absolutely right, because that's not necessarily the kind of investment I think is really going to meaningfully drive Peloton, and much better that they're making the investments that they're making.
So another thing that he said in the conference call, I think, or sometime around then, was that Foley described the market reaction after the IPO as, quote, a perfect storm of being lopped into all kinds of buckets that were unfortunate and wrong. And my response to that is, this is yet another misuse of the perfect storm, which should be thought of as kind of a 1 in 100 years type of thing, rather than, oh, our stock is down 20% after the IPO because we have no profits. Like, oh, that's just because you're comparing us to wrong things like other unprofitable companies. Or, you know, I think that if they deliver profits, they'll find the market is very receptive to their story.
I don't know, John Foley, but yeah, that's a little whiny. And to your point, a complete misuse of the phrase perfect storm.
And you could get it. I used to write an article about the misuse of perfect storm, and you could Google perfect storm at any day of the year and come up with 4 or 5 things which were apparently perfect storms. And they would involve, you know, whatever happened in politics that day to, you know, some stock to, you know, an individual baseball game.
Have you read that book, The Perfect Storm?
Yes, great book.
Such a great book.
Such a great book.
And one of those books that whenever people, you know, whether it's posting on Facebook or on Twitter or just in conversation, they're like, I'm looking for a new book. You know, that is a book that I will throw out there as, have you read this book? Because if you haven't read The Perfect Storm, you absolutely should. It is brilliantly written. If you've seen the movie with George Clooney and Mark Wahlberg, that's fine.
Yeah, I had no interest in seeing that.
But
I like all the actors in it, but I didn't expect it to live up to the book.
Does any movie live up to the book?
Sure, many.
Like what?
You don't have time.
Okay. Well, that's not one of them.
The Godfather. Not a great book.
All right, we're not going to get into this now. I'll just say, if you haven't
Godfather 2.
If you haven't read The Perfect Storm, you absolutely should.
Your favorite? Godfather 3?
Godfather 3. It has some merits. I'm just saying it has some merits.
The merits which you've discussed on Apropos of Nothings.
Yes, and we've gotten a couple of questions lately through email and on Twitter, and I think we mentioned this a month or so ago, but for those who are relatively new to the show, once or twice a year we'll do a special episode of Market Foolery, special in air quotes, called Apropos of Nothing, and it has nothing to do with investing or business. And it's myself and Bill and a third person, and we've got one coming up. It will absolutely happen. I would say, what's today, November 5th?
Or we're absolutely recording it like Monday, aren't we?
Yeah, no, we're recording. I'm just not sure when it's going to go.
Well, it goes through months of editing.
Well, there's editing, there's legal.
There's the production values, there's the soundtrack.
Yeah, there's all sorts of things that go into it.
So like Tuesday or Wednesday of next week.
Yeah, something like that.
Yeah.
I would say in the next month.
Thursday, maybe.
We'll drop that up.
Are you going to do an episode next Thursday?
Yes. So next week is the Motley Fool's annual meeting, Foolapalooza, as we call it here at the Motley Fool. We've got 24 of our colleagues coming in from global offices here to Fool HQ, and we'll be out of the office Thursday and Friday of next week. But we will be recording. I will be recording an episode of Market Foolery to go next Thursday.
So if you've got questions, this will be one of those mailbag ones. Are you going to pretend that it's like being recorded on the day?
No,
of?
I'm going to tell people. I've just told people we're recording this at a time. Like no. So
if you got questions, you're looking for something to fill up that episode.
I mean, I had a couple of ideas, but we always love questions.
You're looking for better questions
from the dozens of listeners. Marketfoolery@fool.com is our email address. Drop us an email. We're lonely, for crying out loud. Just drop us an email. Bill Barker, thanks for being here.
Thanks for having me.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show's mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.